Okay, so you want to own a GLP-1 weight loss clinic. You watch the news. Ozempic, Wegovy, Mounjaro. These weight loss drugs are everywhere. Celebrities are using them. Your friends are using them. Your doctor is getting requests for them daily. The market is massive. Over 40 million Americans are obese. Another 100 million are overweight. The addressable market is 140 million people. Even capturing 1% is 1.4 million patients. At $300 to $500 per month per patient, that's $420 billion to $840 billion in annual revenue potential. The margins look extraordinary. You prescribe a medication that costs $30 to $80 per month wholesale. You sell it to patients for $300 to $500. You mark up 300% to 500%. The patient loves you because they're losing weight. Doctors are giving prescriptions because the demand is insane. Insurance often doesn't cover it, so patients pay out of pocket. It sounds like owning a printing press that prints money while solving an obesity crisis. It sounds like owning a weight loss clinic in 2023 when GLP-1 drugs just exploded into public consciousness, when media coverage was everywhere, when regulatory enforcement was minimal, and when anyone with a medical license and a willingness to prescribe could build a multi-million-dollar business overnight. That is exactly what's happening right now. The GLP-1 weight loss clinic space is experiencing explosive growth. Thousands of telehealth weight loss clinics have launched. Direct-to-consumer brands have exploded. Traditional medical practices are pivoting to weight loss. The money is flowing. Revenue numbers are staggering. Some clinics are doing $500,000 per month. Some are approaching $10 million in annual revenue after just 1 year of operation. The margins are real. The market is massive. But here's what's actually happening beneath the surface that almost nobody is discussing openly. The GLP-1 clinic space is experiencing a dangerous collision between explosive opportunity, minimal regulation, and massive hidden risks that most owners don't understand. Some clinic owners are genuinely making extraordinary money. Many are operating in legal gray zones. And a significant number are about to face the consequences of regulatory crackdowns, insurance company pushback, and patient outcomes that don't match the marketing narrative. By the end of this, you will know exactly where the money comes from, what the hidden risks really are, and what separates the GLP-1 clinics that build sustainable businesses from the ones that are boom and bust operations waiting for regulatory enforcement. What a GLP-1 weight loss clinic actually sells. The disruption illusion: people assume that owning a GLP-1 clinic means you're providing medical weight loss services. You are. But that's not where the profit actually comes from. If you're providing comprehensive weight loss care, nutritional counseling, behavioral coaching, exercise programming, medical supervision, the margins are moderate and the liability is high. What most GLP-1 clinics actually sell is convenient access to medication plus minimal supervision. The business model is telehealth efficiency. A patient books a consultation on their phone. A nurse practitioner or physician assistant, not a doctor, spends 15 to 30 minutes reviewing their medical history and then prescribes medication. The patient never meets the prescriber in person. The medication is sourced from a compounding pharmacy, a supplier, or a dropshipper. The patient receives it by mail. Follow-up is minimal. A quick check-in call in 30 days. That's it. This is the actual model. This is where the money comes from. But here's what nobody is discussing openly. This model has massive hidden risks. The medications have serious side effects: nausea, vomiting, gastrointestinal distress. Some patients develop pancreatitis. Some develop gallstones. Some develop thyroid issues. Some have psychiatric side effects. If a patient has a bad outcome, they might sue. They might report you to the medical board. They might go to the media. The liability exposure is enormous, and most clinic owners are operating with minimal medical oversight, minimal patient screening, and minimal follow-up. They're optimizing for throughput and revenue, not patient safety. This is the ticking time bomb in the GLP-1 space that nobody wants to acknowledge. The full upfront investment, what actually costs money. Everyone talks about the revenue per patient. Nobody talks about the capital required to operate even a minimal telehealth clinic. Medical license and credentialing, $50,000 to $150,000. If you're a physician, you already have this. If you're starting a clinic and hiring clinicians, you need properly licensed and credentialed providers. This costs $20,000 to $50,000 per provider, including background checks, insurance credentialing, and state licensing. Software and technology infrastructure, $30,000 to $100,000. Telehealth platform. Patient management system. Electronic health records. Payment processing. Prescription management. HIPAA-compliant infrastructure. This is non-negotiable. Cost, $30,000 to $100,000 to build out properly. Medical licensing and insurance, $10,000 to $50,000 annually. State medical licensing. Malpractice insurance, $500 to $2,000 per month depending on coverage. General liability. Cyber liability. This is substantial and ongoing. Medication supply chain, $50,000 to $200,000 initial. You need relationships with compounding pharmacies, GLP-1 suppliers, or wholesalers. Initial inventory and supplier deposits. Cost varies based on volume and source. Marketing and customer acquisition, $50,000 to $500,000. This is the biggest variable. Digital advertising. Social media. Influencer partnerships. Google ads. Facebook ads. TikTok. The GLP-1 clinic space is saturated with paid ads. CAC, customer acquisition cost, is $30 to $150 per patient depending on channel and market saturation. Office space or virtual infrastructure, $0 to $50,000. Most GLP-1 clinics are pure telehealth. Zero office cost. Some have virtual receptionists and support staff working remotely. Some maintain a small office for credibility. Cost, $0 to $50,000. Staff, $100,000 to $300,000. Initial nurse practitioners or physician assistants. Administrative staff. Customer service. Initial payroll during ramp-up. Cost, $100,000 to $300,000. Legal and compliance setup, $20,000 to $50,000. Business structure. Privacy policies. Patient agreements. Terms of service. Legal consultation. Cost, $20,000 to $50,000. The real total investment. For a legitimate telehealth GLP-1 clinic, the total upfront investment is $300,000 to $1.2 million depending on scope and scale. Some clinics operate with $50,000 to $100,000 in capital and bootstrap through revenue. Some raise venture capital expecting hypergrowth. The capital requirements are actually lower than most healthcare businesses, which is part of why so many have launched. Where the money actually comes from, the revenue model that works. A GLP-1 clinic's revenue model is simple. Per patient economics. Initial consultation, $150 to $300, one time. Monthly medication cost, $300 to $500. Monthly follow-up/monitoring, $50 to $150 total per patient monthly. $350 to $650 annual per patient. $4,200 to $7,800. Patient acquisition and retention. Customer acquisition cost, $30 to $150 patient lifetime value, $4,200 to $20,000, depending on retention. Payback period, 1 to 6 months. Profit per retained patient, $1,000 to $5,000 plus. The math that works. 100 patients at $400 monthly average equals $40,000 monthly revenue or $480,000 annually. Operating costs. Staff, 2 NPs at $80,000 each plus support staff. $250,000 medication costs, 35% of revenue. $168,000 marketing. $50,000 technology/licensing, $30,000 other operating costs, $30,000 total, $528,000. This clinic is losing $48,000 annually on 100 patients. But here's the reality, most clinics are much larger. The actual scale most successful clinics achieve, 500 patients at $400 monthly equals $2 million annually. Operating costs remain similar on a per patient basis, but fixed costs don't scale proportionally. Staff, 10 clinicians at $80,000 to $100,000 each. $900,000 medication costs, 35% $700,000 marketing, $100,000 technology/licensing, $50,000 other operating costs, $100,000 total, $1,850,000 net profit, $150,000 on $2 million revenue equals 7.5% margin. But wait. This assumes the clinic scales efficiently and maintains consistent operations. Here's what actually happens. The operating cost reality for a scaled GLP-1 clinic, a clinic that's actually successful. Patient base, 1,000 active patients. Average monthly revenue per patient, $450 monthly revenue, $450,000 annual revenue, $5,400,000 operating costs, clinician labor, 15 to 20 clinicians, $1,500,000, medication costs, 35 to 40% of revenue, $2,160,000, marketing and CAC, 10 to 15%, $810,000, customer support/administrative, 5 to 8%, $324,000, technology software infrastructure, $100,000, medical licensing/insurance, 3 to 5%, $200,000, office/operational overhead, $150,000, payment processing/banking, 2 to 3%, $135,000, legal compliance consulting, $75,000, other/contingency, 3 to 5%, $200,000, total operating costs, $5,654,000, operating loss, $254,000, annual loss, $254,000. A clinic with $5.4 million in revenue is losing $254,000 annually. The model is unprofitable at scale due to medication costs and marketing spending. What GLP-1 clinic owners don't account for: the hidden costs and risks. Medication cost volatility. The price of GLP-1 medications is volatile. Compounding pharmacies charge different rates. Some clinics source from international suppliers at lower costs and higher legal risk. As competition intensifies, suppliers raise prices. Medication cost margins are shrinking. What was 60% gross margin is becoming 40% to 50% as medication costs rise. Marketing cost explosion. Early clinics had low CAC because they were novel. Now, every clinic is spending aggressively on Facebook, Google, TikTok ads. CAC has inflated from $30 to $50 initially to $100 to $200 plus in saturated markets. Paid advertising is consuming 15% to 25% of revenue. This compresses margins dramatically. Patient attrition and churn. Patients achieve their weight loss goals and leave. Patients stop seeing results. Patients get scared by side effects and quit. Patients get bored and stop taking medication. Average patient lifetime is 6 to 12 months. Some shorter. This means you need to constantly acquire new patients. You're on a treadmill. Regulatory scrutiny. State medical boards are increasingly scrutinizing telehealth weight loss clinics. Some states are implementing new regulations. Some are prosecuting clinics for inadequate medical supervision. The FDA is monitoring compounded GLP-1 medications. DA is concerned about supply chain diversion. Regulatory enforcement could shut down clinics operating in gray zones. Insurance company pushback. Insurance companies are investigating whether they should cover or deny GLP-1 medications for weight loss. Some are denying coverage. Some are limiting quantity and duration. This affects patient access and ability to pay. Patients on insurance have different economics than self-pay patients. Liability and patient outcomes. A patient has a serious adverse event. Pancreatitis, thyroid cancer, psychiatric crisis. They sue. They complain to the medical board. Malpractice. Insurance covers some exposure but not all. A single major claim can destroy a clinic's reputation and profitability. The GLP-1 clinic that's actually profitable. You position yourself as premium, not commodity. You offer comprehensive weight loss coaching, nutritional counseling, and behavioral support. You charge $200 to $400 per month just for the coaching, plus medication costs are separate. You maintain lower patient volume at 200 to 300 patients. You focus on patient outcomes and retention, not growth. Your patients stay 18 to 24 months instead of 6 to 12. Annual patient retention, 60% to 70% instead of 30% to 50%. You generate higher lifetime value per patient with lower marketing costs. You achieve 20% to 30% net margins through premium positioning. Alternatively, you partner with existing medical practices that have existing patient relationships. You're providing the infrastructure and expertise. You're splitting revenue with the practice. This reduces your CAC to zero and your licensing complexity. You scale leverage instead of building from scratch. The bad scenario. The more common outcome: you open a telehealth GLP-1 clinic with $100,000 in capital. You launch aggressive paid advertising. You acquire 500 patients in the first 6 months. Revenue is $200,000 per month. But operating costs are also $180,000 per month. Your profit is $20,000 per month or $240,000 annually. This seems great. But your CAC is high. Your patient churn is high. Half your patients leave by month 8. You need constant new patient acquisition. Marketing spending increases. By month 12, you have 400 active patients instead of 500. Revenue is $160,000. Operating costs remain $160,000, fixed costs don't scale down. You're breaking even. By month 18, you're losing money. You've exhausted your capital reserves. You're shut down or acquired at a fraction of initial value. The hidden advantage of vertical integration: clinics that own or partner with compounding pharmacies, supplement companies, or product lines generate additional margin streams. Instead of buying GLP-1 at $40 and marking it to $400, they source at $30, compound it, package it, and sell at $400. The markup is higher. The margin structure is better. This is why several successful clinics are building pharmacy partnerships or acquiring their own pharmacy operations. The bubble dynamics. Why this is a gold rush: the GLP-1 clinic space is experiencing bubble dynamics, explosive growth, new clinics launching weekly, low barriers to entry, medical license plus telehealth platform equals business, high customer demand, millions of people want weight loss drugs, venture capital interest, VC firms are funding GLP-1 clinics aggressively, minimal regulation. Currently underregulated compared to traditional healthcare, winner take most dynamics, largest, best capitalized. Clinics will dominate. This creates a bubble where capital flows in aggressively, clinics scale fast, margins compress, and then the weaker players fail. The survivors consolidate and raise capital. The cycle continues. The regulatory reckoning coming. Regulatory enforcement is starting. State medical boards are investigating clinics for inadequate supervision. The DA is concerned about GLP-1 diversion and counterfeiting. The FDA is scrutinizing compounded medications. Insurance companies are tightening coverage. Patient complaints are increasing. Within 24 to 36 months, expect stricter telemedicine supervision requirements, mandatory in-person evaluations for some patients, pricing regulations or insurance coverage mandates, liability crackdowns on inadequate monitoring, pharmacy regulations on compounding and supply. This will eliminate many marginal clinics that are operating in gray zones. Conclusion: the actual economics of GLP-1 clinic ownership. Owning a GLP-1 weight loss clinic is a high-growth, high-risk business with massive market potential but serious hidden costs and regulatory exposure. The unit economics look excellent initially but compress dramatically as competition intensifies and medication costs rise. The money in GLP-1 clinics goes to 4 groups. First, venture capital firms funding the explosive growth. Second, medication suppliers and compounding pharmacies capturing margin. Third, marketing firms acquiring patient attention. Fourth, clinic operators capturing what remains after all costs. The separation between clinics that build sustainable businesses and those that boom and bust comes down to 3 factors. Patient outcome focus instead of pure growth focus. Revenue diversification beyond medication sales. Preparation for regulatory changes before they happen. A GLP-1 clinic built on premium positioning, comprehensive patient care, and vertical integration into pharmacy can generate 20% to 30% net margins and sustainable returns. A GLP-1 clinic built on cheap marketing acquisition, minimal medical supervision, and pure commodity medication sales will likely fail as margins compress and regulation tightens. Here's what nobody is discussing openly. The GLP-1 clinic space is experiencing a classic boom-bust cycle. Capital is flooding in. Clinics are launching. Margins are initially extraordinary. But as supply increases, competition intensifies, and regulatory enforcement begins, most clinics will become unprofitable. The survivors will be the well-capitalized platforms that can absorb margin compression and operate at scale. The clinic owners who launch now betting on current economics will likely fail within 24 to 36 months. This is the gold rush no one is watching. The gold is real. But most prospectors will go broke. The money will flow to the capital providers and infrastructure companies, not to the clinics themselves. Understand this dynamic before you invest hundreds of thousands of dollars in a GLP-1 clinic in 2026.